Hi, it's Mo. Welcome back to the property vlog. This week I've had to deliver some awful news to our investors. So this week has been particularly difficult for me because I've had to make a series of phone calls and send emails that I really didn't want to have to make. So what was this news? Well, despite the sort of clickbaity title, it's not that we've lost all of our investors' money. It is in fact that we are repaying them ahead of schedule, or repaying some of them ahead of schedule. So why is that bad news, I hear you ask? Well, the truth is some of these investors have been investing with us for 2, 3, 4, sometimes even 5 years, and the reality is they don't want their money back. So sort of me ringing them and saying, by the way, I think we're going to have to pay your money back, or pay some of your money back, or have a discussion around interest rates isn't really the news they wanted to hear. I suppose it's better than me calling and saying, project's gone bad, we're not going to be able to return your money. So I definitely don't want to have to make those calls, and I'm sure the investors don't want to receive them. So yeah, so it has been difficult. So despite the fact that it is overall good news, it shows that the business plan and the strategy is working in terms of the projects that we've done. We've refinanced them at the levels that we thought. We've sold units at the prices that we thought. We were able to realise some of the cash and return that to investors. So the model's working, but unfortunately it does mean investors that were enjoying good interest rates and interest paid monthly have now had their money returned. But there is one lesson in this for us, and that's sort of the difference between a legal contract and someone's understanding. And I think this is a really important point, whether it's in terms of your employees, your team, whether it's in terms of investors, like any kind of contract that you have. There is a difference between where you stand legally and what's written in the contract and what the sort of general understanding of the agreement was. And I suppose the spirit of the agreement is what you'd call it, not necessarily what's in black and white and what you would hold up in court, but the sort of spirit that you went into it. And I think some of our investors have been investing for a few years. Every time the loan agreements have come up for renewal, we've said, look, we've got an opportunity to pay the cash back now. We'd like to continue rolling this loan forward so we can do more projects. What do you think? And probably, I think all, maybe bar 1 or 2 conversations, pretty much every conversation is, yeah, keep it in. I'm enjoying having the monthly interest. I'm enjoying seeing the progress of the sites. It's great to see you rescuing sort of old buildings and bringing them back to life. So those conversations have always gone down the line of, yeah, just keep the money, keep investing it, and keep paying me the interest. So the spirit of those agreements that we went into always extended to the full term of the agreement, and even we do have terms in our contracts and our loan agreements that say after a certain minimum period, usually about 6 months, but it does vary on different agreements. It does say in there that we will, or we have the opportunity to repay without penalty, and we'll at any point after, say, 6 months. So no early repayment charges. We'll pay daily interest up until the date that it's repaid, of course, because the loan has gone to that date. But actually, we won't be penalised for paying that money back any sooner in terms of early repayment charges. So you might get, on a mortgage, you might get early repayment charges because the mortgage company want to know that their money that they've deployed, that they've had to borrow from somewhere else, usually, is going to be deployed for a certain amount of time. So that's sort of the reason why they have those early repayment charges in. So we always have a certain period, usually 6 months, in the agreement, and then after that it will basically go to no early repayment charges. If we repay it after that time, we'll pay the interest up to the date we repay it, and that's the end of it. So I suppose the lesson learned from our side, is we've gone through a phase of growth. We've taken on a fair amount of investment to do the projects that we've wanted to do. Going forward, what we will do is have much clearer conversations with investors around the fact that there might be an opportunity for us to repay this sooner. And if that happens, there's a clause in the contract that says, after X period, we'll repay it without any kind of penalty. We'll repay the interest up to that date, but no further sort of penalties or fees or anything. And just really make sure the investors understand that. So, and I think that's a really good lesson learned for me. I mean, we haven't had any, I think some of the investors have been disappointed that the investments have come to an end and they've had their money back. It sounds silly to say the investment's been successful and they've had their money back, but earlier than what they maybe thought in their head. So on the whole, everyone's been happy to have their money back. But I think the lesson learned for me is just really make sure, go through every clause of the loan agreement in future. Just make sure investors understand that that there's a term, maybe 2, 3, 4, 5 years, but after X period, we do have the opportunity to repay the money. And in the same way we have loan agreements that are for, whatever period. If the investor comes to us and says, look, I've had change in personal circumstances, or I really need this money, or I need some of it, or is there any way we can, pull some of the investment out, whatever. We're always completely flexible about that. We understand people's situations change. We're not always in a position to pay it on demand. Property is a fairly illiquid business. Sometimes you've got money invested in projects that might be for a couple of years. It's not very easy to get money out at short notice, but we'll have a chat with the investor and say, well, look, we've got some investments that are maturing over here, or we've got some units that we're selling or refinancing. It's going to come in X months. We can repay you a bit here and a bit here, and actually we can break the loan agreement in the favour of the investor. Not all the time. The length of the agreement is there to ensure there's sort of clarity on how long we've got that money to be able to use it for. But there has to be some flexibility. That's what we're about as a company. So in some cases we will speak to, or the investors will approach us and say, I could really do with that money, either all of it or a bit of it. And we'll have a conversation with them about that. The other side of the conversations I've been having with investors is also about interest rates and sort of other terms around the loan agreement. So length of term, interest rates, early repayments, all those things that are thrown in, but predominantly around interest rates. And I suppose it comes back to a sort of fundamental sort of supply and demand. When you're starting out in property, you don't have track record, you don't have credibility, you don't have a network of people, you don't have projects that you can point to, you don't have a brochure of successful projects that you can point to, you don't have real life challenges that you can talk about and how you've overcome them, and you don't have physical assets to be able to secure loans against. You might not have that many personal assets, the business assets might not be that much, you might not have that much property, so you're really limited in what you can offer investors. So one of the biggest things you can do is to increase interest rates. So when you start out, invariably the interest rates that you pay will be higher. And I remember we've actually had a couple of loans that have been at sort of, I think one was 18%, one was 20%. The 20% one, this is 20% per annum, the 20% one actually came with a penalty interest clause of 30%. So if we'd defaulted on the initial term, the interest would have gone to 30% a year. That's 2.5% a month. It's an extraordinary amount of money and interest to be paying. So when you start out, the point is, when you start out, if you don't have credibility, you don't have track record, you don't have network, you don't have lots of people willing to invest their money with you, you don't have physical assets you can secure against, you don't have challenges that you've overcome that you can point to and say that this is how we handled it, didn't always go away, but this is how we've handled it. Unfortunately, you are going to be paying higher interest rates, and that's what we did sort of at the beginning. But what does that mean now? Well, now, over time, those interest rates have come down because interest rates are tied to, in investment, interest rates are tied to the security and the risk overall of the investment. And investing in an established property company with track record, with physical assets that stand behind them, with experience overcoming certain issues, with skilled contractors, consultants, skilled power team, people on hand to resolve issues. Fundamentally, the risk profile is different for someone investing in that type of company, and that's what we've grown into now. I'm not saying that we're perfect and everything's going to go, always go the way we want it to, but the experience that we've got over the last few years, and obviously there's more to learn, but the experience we've got over the last few years does put us in a position where if you put an investment with us against a new property investment company, it is objectively lower risk to invest with us, and that means that the rates have to be lower. So over time, the rates have come down, and we're now paying sort of between, mortgages are sort of 3 to 4.5% typically, depending on whether it's personal name, limited company, HMO or flat. So they're the sort of ranges that we pay on that. And then private investment that we're paying, depending on the security and the term and things like that, we're paying sort of 6 to 8% now, and that's across the board. And that's come down, like I said, from at one point 18, 20% with 30% penalty clauses. So sort of that's come down over time, and that's again another part of the conversation that we've been having with investors. On the one hand, it's a good news story because we're paying money back and we're credible and we're executing on the plan that we said. But on the other hand, it's now a lower risk investment, and unfortunately, there's no yield, there's no return anywhere, unless you want to really speculate at the moment. Interest rates are historically low and all that. You can't really get a return on your money, a decent return anywhere. And investing with us is, riskier than putting the money in the bank, and that's reflected. It's not FSCS guaranteed, and if we went bust, the government aren't going to step in and bail us out. So that's why putting it in the bank and getting 0.01% or whatever might be right for some people. But given what we've done, the track record that we've got, the right rate for investments with us, with appropriate security, whatever the specific situation is, whether that's personal guarantee, second charges, share of first charge, whatever, the right rate now is 6 to 8%, and for mortgages 3 to 5%. So that's sort of where we are at the moment. So one thing I probably should mention is that all of the investors that we've spoken to, well, the majority of them have sort of turned around and said, it is disappointing. Obviously, we wanted the money to be deployed for longer. Some of them have been in, like I said, 2, 3, 4, 5 years, and they were expecting it to sort of go for that sort of term again. But the majority, almost all of them, have said, let us know when the next project's happening, and we'll have a chat. And actually, a couple have even said they're actually going to hold on to the money and not put it in anything else, because we've got a couple more projects coming through imminently, so there is going to be opportunities to invest further. So I suppose that's how I wanted to sort of close off the video as well, that actually we've repaid a load of money, the projects that we've done have been successful, and we've refinanced or sold as per the plan. But there is going to be a point in time, and it's probably going to be in the next couple of months, that we are going to be reaching out to investors to invest in the next tranche of projects. Whether that's developments or properties that we're holding on to, So I suppose the point is, if you are looking to invest in the future, give us a shout. I'll put my details below. We can have a chat and we can get you on a list, a sort of waiting list for future investment opportunities. I can get your details. We can send the investment opportunities out as and when, and then you can decide if that's the right time to invest. So hope you enjoyed that. Just a quick update about sort of how we work with investors and sort of difficult conversations that we've had, that we've been having over the last couple of weeks, and difficult because we're wanting to pay money back, and where people want to keep money invested, where investors want to keep money invested, we're having a discussion around rates to sort of align them more to the current risk profile and experience that we've got within the company. So thank you for watching. Please remember to subscribe, hit the subscribe button, share this video with anyone that you think might find it of value, and we'll see you next week.